Well, good morning, everyone. Thank you for the opportunity to speak on, from a bank's perspective, on community bank competition. By way of background, East Cambridge Savings Bank is a state-chartered mutual. We have total assets of about $1.1 billion. We're headquartered in Cambridge, Massachusetts. 10 branches serving 7 cities and towns, three counties. And we were chartered in 1854. And we were chartered then to serve the people of modest means at a time when they were considered the unbanked population. And we are not the oldest mutual in Massachusetts. And our first president was also a reverend. I heard that yesterday, and I thought that was pretty interesting. Our ownership structure is a mutual holding company. So we have no outside shareholders, and we are not privately held. Our ability to grow is solely based on our own growth in earnings. And a little bit of me, I've been with the bank nearing 42 years, and I've been a customer for over 50 years. So as I read the papers, I felt that we were the community bank in the middle of those papers. So I really do appreciate having the opportunity to share it with you. Also, I do echo a lot of what I read in the papers, maybe from a slightly different angle, but found that all very, very interesting. On the effects of competition in consumer credit markets, obviously financial regulation will either rein in activity or promote it by removing barriers. And when we consider the credit union industry and the expansion that it's had over the years, that was sparked largely by the regulatory exemptions. And competition is there for all lines, as well as it's for all lines, for all customers, and it truly has intensified. And when financial institutions compromise on their credit standards, as some of the research led to in terms of delinquencies, credit quality, not only does it negatively impact our industry, but it clearly impacts the communities that we're serving. In certain markets, and it's been said already multiple times during this conference, in certain markets, that small community bank is the economic engine to that community. Now, distinction between banks and credit unions has long been blurred. And once fundamentally different, credit unions labeled as not-for-profit, member-owned, credit unions have simply become banks. In Massachusetts, credit unions, mainly driven by a large few aggressively looking to capture market share. A May 2016 study that covered the period of 2001 through 2014, and this was by Polycon Research, it noted that the 10 largest credit unions in the state held 50% of the industry, with the largest credit union holding 20% of all industry assets. That same largest credit union in 2004 purchased naming rights to an arena and a convention center and served 700,000 members in 50 states. So very similar to your example. The common bond restriction, it was designed to strictly define membership to ensure that credit unions served low-income borrowers and depositors. The low-income designation from NCUA and the easing of this common bond has allowed the expansion of services to individuals and businesses of all financial means throughout our state and obviously beyond. In fact, the number of low-income designated credit unions in Massachusetts had risen from 11 in 2012 to 57 in 2016, including 4 of the state's largest credit unions with assets in excess of $1 billion. And just as a point of reference, Massachusetts credit unions hold close to $40 billion in deposits. And to attain low-income status in select, more affluent markets, certain credit unions targeted students and other youth as a means to increase their low-income member base. Now, it's also important to note that federal credit unions are exempt from the Community Reinvestment Act. both at a state, at a federal level, but in Massachusetts, we also have a CRA, a state CRA, and they too are exempt from that. And it's obviously difficult to measure whether low-income communities are being served as they were intended. Now, tax policy has also contributed to a competitive environment. Credit unions were originally granted the tax exemption as an incentive to serve the needs of individuals of modest means. Sort of the CRA of credit unions was through that tax. However, credit unions serve all income levels. And the tax exemption provides additional income that appears to be supporting marketing efforts and not necessarily better pricing for members. Except for the automobile financing, credit union rates and products are no better than what bank offerings are. And in fact, we recently, well, in 2014, we acquired a $60 million bank in one of our local communities, and across the street is the second largest credit union in the state. And in fact, we purchase loans because they have such a large origination team that we will actually purchase loans for portfolio from the credit union. Now, this subsidized competitive environment is not only increasing competition for community banks, it's important to note that it's increasing competition for the credit union industry. And this is where there's that easing of credit, and this is where there may be that evidence that the quality of credit is beginning to also show signs of deterioration. Of course, having successfully attained all of this additional funding, well, you have to put the newfound money into work. And for credit unions, they have they're well established in business lines, both consumer but also for commercial lending, and that is what we're seeing happen. Now, the other piece that is the an interesting effort, and that is to increase the credit limit that credit unions currently have. Of course, we're extremely opposed to it, and that's partly because, based on research, by increasing the lending cap for credit unions, the benefit would only be for 0.5% of the credit union industry, which means it's the largest credit unions, again, growing larger. On the liability side, we also strongly oppose an effort by credit unions to become or to serve municipalities. And it's ironic that a financial institution, not a credit union, but a financial institution would compete and be able to be the depository bank for tax revenues. Something that obviously we oppose. Now, generally speaking, this is not opposing competition. This is about the advantages through exemptions that create an imbalance in our overall competitive landscape. And even when comparing large credit unions to their smaller peers that remain true to the original purpose, the competition is intense. So for the 12-year period that was studied in this Polycon report, deposit growth at the 10 largest credit unions in Massachusetts increased by 161%, while deposits at all other credit unions increased by 42%. So the change in this credit union business model has been by far more aggressive on the applied marketing strategies and not on pricing. So the response from local banks obviously is competitive survival. Now, with respect to the automobile lending business and the shifts in balance sheets, we and many of our peers were out of the automobile lending business when the auto dealership financial arms became lenders in this space because they were offering rates at much, much lower rates than we would offer or that were market rates. So naturally, the credit unions whose business models favored more the consumer lending became more prominent players in this space. And they did it through direct lending as well as indirect lending. The consumer demand, for the most part, and the income opportunities is what drives our balance sheet mix and not necessarily the credit unions. So in my experience, credit unions are banks competing for all loans. in all forms of deposits, and the playing field should be leveled for all institutions and for the overall health of our financial industry. Now, in terms of the competitive effect of megabanks on community banks, in the Boston area, where the competitive market footprint is extremely tight, M&A activity is strong and consistent. It's happening probably today as we speak. And because of that activity, naturally, the number of small banks are decreasing, serving as independent banks. That is definitely a decreasing number. And in our market, we really don't see any evidence of the mega banks coming in. And the reality is they already hold the biggest share of the market. So to a point of why would you go through the effort and the cost of acquiring a small bank? It's just not worth it. Add another branch, and if you even need to do that, and the task is done. But generally speaking, there are three types of mergers and acquisitions taking place, again, in a very tight Boston and surrounding area. And that is, the first combination is small to medium-sized community banks simply looking to expand their market, looking to become more efficient. The second is the small bank who sees the writing on the wall. They cannot compete. They just don't have economies of scale to continue to compete. And then the third, transactions of all size when succession, management, leadership succession needs to be addressed. Now, while competition from these larger banks can constrain small banks, I strongly believe that it's the stronger headwinds are that small banks truly face an inability to attain economies of scale. And the cost structure of doing business today for so many community banks is just so much higher than that they can handle. And considering the tight footprint in more populated areas of Massachusetts, bank combinations have resulted in that decreased number of branches. But having said that, through this consolidation, the community is better served. And the community is better served because the surviving combined bank has multiplied in size. It maintains its presence and its history, and it's doing so while providing the community with those values that the community has come to expect and appreciate. And when you measure the movement of the banking relationships as it relates to small bank combinations, we don't see much in terms of change. Provided that the combining institutions have the same values, pretty much operate under the same business models, it's fairly transparent. That is not the case that I can refer to in my 40 plus years of banking in that exact market. That's not the case with large banks. You do see a change. Consumers bank with small banks for a reason. And when they feel that that's threatened, you do see a change take place. Now, but the research paper does show that those advantages of these mergers, the fact that they're short-lived. And I believe that they're short-lived because when it's all said and done, once the merger takes place and once things settle down, those economies of scale surface right back up to the top, and that becomes the continuing challenge. Regarding small branches in urban areas faring worse than their counterparts in rural, one challenge is simply this, and it's been pointed out, it's the sheer volume of market competitors. We're all going for the same deposits, for the same loans. And the situation really does become problematic when a small or a medium-sized bank is looking to increase the value of their franchise, possibly through acquisition, and they begin to offer rates that are much higher than market. It is not, for the remaining competition, responding in kind is not a sustainable strategy over the long term. And as the paper points out, the fact that larger institutions can obviously manage margin compression far better than institutions of smaller size. And as for branches in rural areas doing better than urban branches, the fact that they have fewer competitors may just mean that the organic growth opportunities are simply lacking, and as such, merger and new entrants is also a limited opportunity for them. So exclusion of a size or business strategy, we obviously all need to grow. And we need to grow at a minimum to cover our operating expenses. So thus, even branches in rural areas that need to expand, they are moving into already very competitive metropolitan areas. They're establishing branches, they're outreaching through electronic means for loans. Now, whether they succeed in attaining economies of scale is to be seen. Finally, with respect to the research on the impact of scandals on community banks, I can honestly say I'm fortunate that I have no firsthand experience. But we do find that, that today's consumer values social responsibility and is environmentally conscious. Recognizing the importance that consumers place on social responsibility, I can speak to the marketing campaigns that we've done in the more recent years. And they are those that give back to the community, that support a community event, planting trees, supporting a local community garden. And community banks do fare well in that area because we're believed to support the community. We're members of the community, not just operating in the community. And generally speaking, as consumers, we want to give business to businesses that align with our values, and we do have, as humans, we have a tendency to distance ourselves and from people in situations where the values don't align. So when scandals that compromise social responsibility gain the attention of communities, they empower response. And an effective response is to communicate your disapproval by removing your business and going somewhere where the values are more in line. And that is something that we have witnessed in our communities. So with that, that does complete my prepared remarks. Thank you very much. It's been an honor to speak to you.
Thank you, Gilda.